Good afternoon and welcome to this webinar on the outlook for FAANG stocks in partnership with Granite Shares. I'm Jamie Gordon, reporter at ETF Stream, and today we'll be putting US big tech under the microscope to see just how long the current sector correction will last and how much innovation potential the largest players have left. Joining us to discuss this, we're pleased to have Will Rind, founder and CEO of Granite Shares, Manoj Sarpal, director and CTO at Granite Shares, Laura Hoy, equity analyst at Hargreaves Lansdown, and Paul Quattrocasas, founder and CEO of Aqua Partners and author of Go Tech or Go Extinct. Thank you all very much for joining us. So just before we start, a reminder to our audience to look in the attachment section below to see links to Granite Shares products and research, and a link to the latest edition of our ETF Insider magazine. Also, please do get your questions into our speakers as I'll be asking them throughout. So I guess a good place to start, sort of setting a scene, is sort of having a look at tech, how it's done so far this year. I think last month, the NASDAQ booked its worst month of performance since 2008. And obviously over the trailing month from this week is down around 26%. So pretty significant and obviously a far cry from what we saw in 2020 and even 2021. Will, can we start with you perhaps? Just a few of your insights on why this has happened, what's gone on this year, and what's the reasoning behind it?
Yeah, thanks, Jamie, and obviously thank you everybody for listening to this morning's webinar. I think I guess the answer to the question is relatively straightforward. Unfortunately, for those of us who are invested in the market, and that's we have the highest inflation that we've seen in the economy since the 1970s. And a Federal Reserve, at least where I am in the United States, and obviously central banks in Europe, that are really trying to wrestle with inflation and trying to fight inflation the best way they can. And obviously, the only tool that they have at their disposal is to raise interest rates. And so the raising of interest rates and then the anticipation of higher rates has caused a lot of problems for the stock market. Clearly, it would be remiss if we didn't mention the Russia-Ukraine situation as well, which has also thrown global markets into chaos. But I think overarching theme here is, especially for markets, is really coming to grips with a higher inflationary and higher interest rate environment.
Yeah, good stuff. And Laura, how do rising interest rates affect tech and growth stocks in particular? Is it something to do with affecting the current value of future cash flows, or is it more of a sort of issue of cost of capital?
Yeah, so I think there are really two things at play there. The first is, it's mathematical. The value of future cash flows is worth less more than interest rates rise. So there is some element of, 100 pounds in the future in 10 years is worth less today than it would be when interest rates rise. And so you're seeing kind of some of these valuations start to play catch up a little bit based on where they've gotten to. I think the second thing, as you pointed out, is people are adjusting to what we thought was going to be more of a temporary situation. Not so long ago, everyone was talking about inflation as if it were transitory. We weren't sure if central banks were going to react. And now we're kind of pretty sure they're going to continue reacting. So there is kind of this huge adjustment that we've made from, the post-pandemic boom to, hang on, how are we going to get inflation under control? So, with that in mind, I think there's just the market adjustment to that. And then you've also got the performance of these stocks. So on top of all the mathematical differences, you've also got earnings coming out that maybe aren't as stellar as they were before. You've got consumers that don't have the same amount of money to spend, and you've got outlooks which aren't quite as rosy as they once were. So it's kind of everything hitting at once, I think, is what's causing the tech sector to be under so much pressure recently.
Yeah. And obviously you mentioned earnings there. Obviously some were quite resilient perhaps in Q1, but others not so much. Obviously, people have been talking quite a bit about the subscriber count for Netflix. In terms of earnings resilience, how does this sort of vary between different sort of US tech subsectors, such as video gaming or video streaming versus, say, something like a semiconductor company?
Yeah, so I mean, obviously, it's all dependent on what the end market's looking like. In the case of Netflix, I think there were two big problems there. The first is Netflix is much further on its streaming journey than most of its competitors. So we're seeing subscriber numbers start to dry up. And I think people were concerned to find that management was not prepared to deal with that. And there was not a concrete plan to kind of deal with these subscriber number losses. But then on the flip side of the coin, as you mentioned, semiconductors, I mean, there's a lot of growth potential there, and it's a totally different problem that they're facing. So a lot of that was supply chain bottlenecks, which, we're expecting to see start to alleviate in the coming years or months, even as some of these factories come online and some of those constraints fall away.
Yeah. And Paul, we've been, obviously this webinar is covering FAANGs, but also to an extent, other sort of large US tech acronyms. So you're talking about FAANGs and FATANG stocks. And of course, these large players make up at the moment roughly a quarter of the S&P 500 and half of the NASDAQ. So a pretty dominant position, even after obviously what has been quite a challenging start to the year. Going forwards in the sort of medium and long term, do you think that these players that we have in this position at the moment can maintain their dominance?
It's a great question. Everybody has an opinion on that, I think, but I would start with the cold hard numbers. And the numbers that I like to use are basically around free cash flow. And I just did a quick check yesterday on the FAANGs, or the top tech stocks, to get a sense of how they stack up free cash flow. And let me just point out those numbers. This is trailing 12 months, so it's typically through March or April 2022. Apple generated $108 billion of free cash flow. Microsoft, $63 billion. Google, $68 billion. Facebook Meta, $35 billion. Amazon, negative $1 billion. And then we have others that we talk about. Netflix, negative $30 million. Snowflake, which has been a darling until recently, negative $11 million. And I'll just throw in one for fun. Tesla, $7 billion. $7 billion free cash flow against GM, which is negative $2.4 billion. And by the way, GM has had negative free cash flow every trailing 12 months going back to 2014, whereas Tesla has been positive free cash flow since December 18. Now that's interesting, especially since I think Kathy Wood mentioned that she was going long on GM. The point here is that there is so much free cash flow being generated by the top tech companies that they are able to attract everything they want at the end of the day. They can attract the right people to work for them, the right talent. They can attract the right partners, commercial partners, and they can acquire companies that they need to acquire when they need to acquire them. And I'll just give one example of Facebook, formerly known Meta, formerly known as Facebook, acquired Instagram. I think it was 2012 for $1 billion headline price. I think in the end it was 600 million. The market was surprised and thought Facebook was overpaying for a company that had 16 people and was losing money. Today, Instagram is probably the core support of Meta's value. And it's a lesson, I think, for these companies that are not only generating multiple billions of free cash flow, but have some of the best management teams, some of the best, not all of them, some of the best corporate governance, some of the best talent in technology, and the best intelligence on what's going on in the world. And I think at the end of the day, when you consider that technology is going exponential, that is where investors ultimately want to be. If you're a long-term investor and not a short-term trader, is you want to be where the smart minds are that are attached to the cash flow, that are attached to the exponential trend.
Yeah, I think the term exponential trend is interesting, and also your point about acquisitions. I think it sort of is quite telling the scale and capability, and obviously the talent, as you mentioned, of these companies now by virtue of their size and obviously their reputation. Obviously, the current drawdown has drawn quite a few comparisons to 20 years ago, the dotcom crash. But really, I mean, there are probably some similarities, but also a number of differences. Laura, perhaps, do you see this sort of comparison as being fair or worthwhile at all?
Yeah, so I mean, obviously there are some parallels. If you look at things like this interest in trading activity, and the number of IPOs that we saw, things like that definitely have led people to compare the dot-com crash, certainly, to what's happening now. But as Paul pointed out, I think that the biggest divergence and the biggest difference is the companies that we're looking at, these mega cap stocks. They're making huge amounts of revenue and profits and free cash flow, as he pointed out. So these aren't the same sort of shell companies that people were investing in back then in the dot-com crash. And I think that's really the biggest thing that people have to keep in mind, is it's just not the same in that respect. Ultimately, whether you want to split hairs on how much the valuations have come up or down, the companies that we're talking about are expensive for good reason. And that's, I guess, the main difference.
Interesting. So obviously with the conversation around interest rates, some of the people we speak to, some of the professional investors, what they're saying is it's the end of the sort of growth epoch of the post-global financial crisis era. We're going to have higher interest rates for longer. If we return to the noughties, it'll be the old economy back in business. Obviously, what you're saying is it's a different ballgame now. These companies are far more established and sort of more sensible businesses now. So do you think there's any sort of really credence at all to this idea that it's sort of going to be a decade of old economy?
I think, you have to also look at the disruptor status of some of these companies. Part of the reason why they got so big so quickly is that they found an industry and either completely formed it themselves or completely disrupted it, turned it on its head. And you can't really go back from there. So as we move forward, and one of the questions a lot of people have is, who should be included in the FAANGs? Is it still the same companies? I think probably the biggest characteristic that sort of puts you in that mega cap hypergrowth category is whether or not you're, disrupting. And I think that's, again, one of the big questions with Netflix right now is, are they able to carry on and keep disrupting this industry, or have we sort of seen the end of that? And, it's the same with Meta. As we move forward with Meta, we're looking at a company that's kind of reached its peak. They've got the largest social media platform on the planet and an impressive number of people logging in every single day. But, they're not going anywhere if they're not changing things, if they're not disrupting. So that's where Instagram and monetizing those videos, and then even further out, the metaverse comes in. You're looking for a company that's going to change things meaningfully, and that's going to drive this entirely new business case for them. And I think, one of the suggested additions has been Tesla, right? Which, there's a lot of debate. Is it a car company? Is it a tech company? But it's the same thing we've seen recently. Tesla's sort of proven that they can deliver their business model at scale, and it's profitable, and they're doing a great job of that. And now the next question is, what's next? And obviously they've got their eye on, autonomous driving and insurance and, all kinds of other subsectors. And I think that's really the earmark of a disruptor company. They've got an eye on the future, and they're ready to sort of change things. And I don't think we can say for sure that we're heading back into the old, economy where we're looking at only value stocks and things like that. I think there's still certainly room for growth in tech.
Interesting. And Will, sort of with this period, obviously it's tested some investors' resilience, especially some of the newer players that have entered over the last year or two, who was trying to ride the post-pandemic highs and sort of euphoria, if you will. How is the sort of popularity of sort of US large cap tech, which has obviously been in focus and sort of mainstay in most investor portfolios, how has that changed so far in 2022? And how do you expect it to evolve going forwards?
Well, I think it's kind of a difficult question to answer in some respects because, clearly prices are down somewhat. And I think we have to also make a separation or distinction between profitable tech and unprofitable tech. And certainly, as Paul's talked about, as Laura's talked about, these companies that make up the FAANG acronyms are, the most valuable companies still in the world today. And for a good reason, is that they're really have monopolistic or semi-monopolistic positions in key markets where there arguably is no alternative. There is no alternative to Google in search. There is no alternative really to Amazon in e-commerce and so on and so forth. And so it's really the unprofitable tech that has been hammered the most in this particular market, and that's for good reason. But I think if we think about the appetite for tech, I'll just use one example, which is, as Paul briefly mentioned the name, but Kathy Wood's ARK Invest, which is in many ways become the kind of poster child for certainly speculative tech or the unprofitable tech, the hyper growth names, with the exception of Tesla, arguably. But that fund, although the performance has been abysmal this year for obvious reasons, it's still getting inflows, and I think that that tells you that people are still ready to buy the dip. That people haven't given up on innovation and they haven't given up on growth. I think if you look at the broader market in some of these names, Robinhood, for example, hugely beaten up name since its IPO and especially this year. But again, an activist investor is willing to step in and buy a good percentage of the company very recently. And there's talk of that happening with companies like Peloton, which is another darling that of the pandemic that has suffered greatly over the last few months. So I think that you ultimately have to think about growth, and the reason why these companies are popular in the first place is because people were willing to pay huge premium for growth, in a market which was where growth was difficult to come by. And I think the argument that value is coming back is a tough one, because if you look at the performance of value versus growth, I'm talking about S&P or US value versus US growth year to date. US growth clearly is down year to date, about 15% down. Value is slightly up, but when I say slightly up, when we did the numbers, it was about 60 basis points up. And so while that does represent a positive performance, what's interesting to me is when you dissect that performance even further, and you say, okay, well, what is contributing to that value performance? It's really just one sector, and that's energy. So banks underperformed, consumer staples underperformed. It's really just been an energy story. And actually, I'll go further and say that explains the entire performance of the S&P 500 from Q4 last year. You've had massive outperformance in energy companies, oil companies in particular, and really nothing else has worked. So if you're in commodities, if you're in energy, you've done well, but almost everything else in the market has not performed. And so I think the question that investors have got to ask themselves is, right now, short term, it may be a good time to own energy, but looking out 10 years, do you want to be in a company like Exxon, or do you want to be in a company like Google or Apple, et cetera? And I think the answer is obvious to the majority of people.
Yeah. And obviously you mentioned people going to tech to hunt for growth within ETF land. Of course, we think about style or factor investing, and we think about things like growth factor or quality or value factor. Obviously, growth comes in many different flavors, as we talked about. You've got profitable and unprofitable companies. Even unprofitable companies going through a boom phase can yield massive returns. Do you think that there is an element there is a place for other styles within sort of the tech sector, such as quality, for instance? You can look at the likes of Apple, perhaps as a quality factor company, or even value in some places. Do you think there are room for other styles within tech? It's not just all growth.
Absolutely. And again, I think it's we've got to be careful about how, not to kind of tar the whole sector or every company with the same brush. I mean, Warren Buffett owns Apple. He is the value investor. And so is Apple a value stock? Again, we could have an argument in a webinar on its own about whether that's the case or not. But I think the important thing is coming back to fundamentals, as Paul's talking about, which is a lot of these FAANG companies have amazing fundamentals. And we're talking about free cash flow, incredibly strong balance sheets, monopolistic positions or semi-monopolistic positions in key industries, which affords them a huge amount of opportunity. And so whether you class certain companies as being more value or being more growth, I'm not sure is necessarily the main point. To me, it's more, there's clearly going to be a preference at the moment for companies that have good free cash flow, that have strong balance sheets, that have good moats around their businesses. In other words, just good businesses, regardless of whether in tech or not. And we ran a slide Jane was interested in. Actually, I can get it to people after the webinar, but we ran an interest rate sensitivity analysis on stocks just more broadly, and particularly with tech stocks, and found again that the interest rate sensitivity is much less than you would think over the long term. And then the main takeaway for me was good companies are interest rate independent. That it's really, if you're going to suffer from higher interest rates, it probably means that your business model is not the best, and therefore, it's really independent of any interest rate moves.
Yeah. And of course, you mentioned some ways of slicing the market, and some people have obviously attributed things like quality to companies like Apple. Another way to slice tech, of course, is not just to go long, but to go short. And obviously, that's something that your company does. Is there an advantage to going short on tech, as you say, especially if you've got a long-term view and you're long-term bullish on innovation? Is there an advantage of having the option to go short?
Well, absolutely, Jamie. I mean, again, this is an environment where short-term, long-term investing is always about the balance between those two factors. And either you're somebody who's just a pure long-term investor and you have the time horizon, the ability to do that, or you can be a mixture of both and take advantage of short-term opportunities as well. And the fact is, this has been the worst year we have on record for the 60-40 portfolio. In other words, a portfolio that consists of 60% equities and 40% bonds. People have lost money in equities, they've lost money in bonds. So what do you do in a market environment like this? And you can either sit on your hands and, as a longer term investor, say, I've got the time horizon to wait this out, or you can try and do something about it and invest in a inverse or a short FAANG ETP, the likes that we obviously offer in this market on a leveraged or an unleveraged basis. And you can put a hedge in your portfolio. And very simply, that's been hugely effective this year for all those investors that have done that. Again, whether you're leveraged or unleveraged.
Mm-hmm. Yeah. Laura, if you look at the moment, everyone seems to think it's a homogeneous downward trend at the moment for tech so far in 2022. There's a fair bit of correlation in that. Do you think an investor right now looking at playing tech in some way, either long or short, should look to do it via a product that targets FAANGs or FATANGs or any other sort of grouping? Or do you think it's more sort of useful perhaps to address tech on a company by company basis?
I mean, obviously it depends on the investor and what their views are and their time horizon. But, I think certainly we've seen not all tech is created equally. And a lot of the results we've seen and a lot of the performances we've seen have diverged from each other, just basically based on, how well that company can perform given the conditions and given the longevity and what their long-term profits will look like.
Yeah. And Paul, same question to you. Do you think that there's enough kind of correlation for investors to bet on a whole sector or the large cap portion of the tech sector, or do you think going company by company has some value?
All depends on the individual investor and whether they're long-term, 20-year buy and hold for 20 years and compound their gains pre-tax, whether they're in or out every quarter, whether they're institutional or not. There's so many ways to answer that question. Fundamentally, the way I look at it is longer term, and therefore, as an investor, I would be and do invest a bit every month, every quarter, because that's one way of guaranteeing you're going to catch the ups and the downs, because none of us know what's going to happen next. No matter how smart we may think we are, we do not know what's going to happen. And so the best way of protecting, if you're long only, certainly is just buying a little bit regularly over time. And in that, I would suggest, and I'm biased here, I would say there's no point to be buying anything but tech. Now, the question is, what type of tech, and it's hard to go wrong, I think, personal view, with the large tech best companies with that methodology, as opposed to having a high concentration of some of the tech companies that haven't yet proven themselves. And I think that's what we're talking about with companies that don't yet have all the fundamentals, and may have grown revenue or their users or whatever traction very strongly, but have they delivered the operating profits and operating cash flow while they're still growing? That's a key question when looking at individual companies.
Yeah, I mean,
and I think if I could just say one thing, that this is where also the index or the product makes a big difference, because we're talking about, you know, the difference between buying tech, you know, as a group or in a fund or individual companies. And I think, you know, the construction of the index or the fund, the stock picks in the fund, is when it makes a big difference. Because we were talking offline just before the webinar, and somebody made a comment about the fact that Tesla, you know, didn't come into the S&P until a certain point after it had made a lot of gains for investors. And I think, you know, clearly if you're buying a FAANG product, you're getting those large cap or mega cap stocks in that particular portfolio. But if you're talking about some of the other names, the more, dare I say it, speculative names, like the Peloton, you're probably not going to find those in a tech ETF or a tech product, because those companies are still, you know, largely probably haven't made it into those indices. And so I think there, if you're looking to invest in one of those particular names, you might not find it in a broad market ETF, etc. And therefore you have to buy those stocks individually, as opposed to, you know, hope that you're going to get exposure by buying a big product.
Yeah, I mean, obviously you mentioned it's about index construction in ETF land. That's something we that chimes with us, you know, extremely. What you also mentioned, having sort of FAANG exposure protects you perhaps from being exposed to companies like your Pelotons and so on. Is market cap sort of a good way to go to sort of act as a safety net in tech?
Well, I mean, our approach was, you know, first and foremost, you know, we have a pure play suite of FAANG ETPs. And the reason for that is because we got frustrated as a firm with the, you know, plethora of thematic ETFs and thematic products in the market that, you know, really are marketed as being one thing, but if you look at the underlying portfolio, it can be sometimes something completely different. In other words, because of the portfolio diversification regulations, you end up with a very diluted mix of companies that may or may not have anything to do with the theme that's been marketed. So what we wanted to create was a pure play way to get exposure, a pure way to get exposure. And we started obviously with the FAANGs and the relevant acronyms, whether you think that Microsoft should be a part of that or Tesla. And we chose equally weighted in terms of the way that we did it. And the reason for that was not to go with the classic market weighted bias and say that if people are buying those companies, we thought that on a performance basis, equally weighted was the best way to go. And we rebalanced that on a quarterly basis.
Yeah. And obviously you don't just have the one-to-one exposures, you've got the short exposures, you've got the leveraged exposures. What sort of advantages does having leverage offer in sort of the large cap tech space?
Well, it gives the, you know, potential for amplified returns over and above an unleveraged either stock or an index. And I think, Jamie, if you got the slides, maybe we have a quick look at slide 19. I'll just run through a couple of examples here.
Get the one here, or
You keep going?
that one there? Or
No, keep going. Looks like, say, 16. Yeah, keep going. That's a list of all the FAANG, obviously, products.
yeah.
And then should be a few slides on from here.
Ahead or backwards?
Ahead, sorry.
No worries. Tell me when.
Yeah, just keep clicking through. That's it. Okay, so let's start here. So just very briefly, this is an example of a couple of 3x short ETPs. This particular chart on the left, we're looking at Facebook, 3x short Facebook or Meta. And on the right-hand side, it's 3x short Netflix. And one of the most obvious ways to invest in single stocks, and particularly with single stock ETPs, is around earnings. And so earnings, in this case, were negative for both of these stocks. And so people that had positioned accordingly when those announcements were made profited handsomely over the earnings. Next slide. I took this one again as a hedging. This is what I was kind of alluding to earlier in our talk, but this is the year-to-date performance of the NASDAQ as measured by the QQQ, most popular NASDAQ ETF, against our short FAANG daily ETP, which is unleveraged. It's just an inverse of the FAANG index that we've created, pure play. And here you can see that performance year to date, as of yesterday, was 72%, sorry, 47% for the SFNG versus about minus 25% for the Qs. And so here's a simple way for people to add a hedge to their portfolio, enable them to profit from clearly falling tech markets. And then the next slide, Jamie, is just the 3x leveraged version of exactly the same product, which, as you might imagine, has performed better because it's 3x leveraged, and that's 163, just over 163% return in a market that fell 25%. So really just an example of how practical case studies of how you can use products in this particular environment to hedge, or of course the opposite way if you become bullish on particular stocks or a particular sector.
Okay.
Yeah, we can go back to the conversation.
Great. Can I just ask the speakers when they're not speaking to mute their microphones? Just at the top there, you'll see a microphone we seem to be getting a bit of feedback. So that'd be great. Oh, there we go. Whoever it was, we've caught them. Paul, you also mentioned that, company by company, not all companies are built the same. So perhaps you could sort of tell us a little bit about which companies are sort of doing the right thing and what it takes to, obviously be doing the right thing versus others who aren't.
Right. Well, I don't want to talk too much about individual single public companies, listed companies, in terms of what they're doing right. But I think I can talk about a company I find very interesting in instructing the Warren Buffett lesson of price is what you pay and value is what you get. Because to me, that's what it all boils down to. The fundamentals point to value. Price is something that goes up and down every day. And there's one company that caught my attention when I was looking at this a few weeks ago. So I'll put up a slide if that's all right. And this is not a FAANG, but it's a tech company. It's called Zoom. I think most of us are familiar with it. We often use Zoom day to day. But here's the lesson. This is what really surprised me when I looked at it closely was when Zoom did its IPO about 3 years ago, almost exactly 3 years ago, it was quite a small company. It only had about $400 million of revenue. Its EBIT, operating profit, was less than $10 million. Free cash flow, $32 million. Its earnings per share, 3 cents. But its share price was $72. This was the price of, I think, the end of April 2019. So it aligns with that data. So there was a PE, excuse me, around the time of Zoom's IPO of 2,600. So if you were buying Zoom back then, and by the way, this is way before the pandemic. You can see this red line here, which is the March 2020 was when we had lockdown. So Zoom was already priced extremely high. This is what we say, priced for perfection. Good company, growing, generating a profit, generating net income, which is relatively rare for hyper growth, early stage, which Zoom was at the time, tech companies. Then, of course, we know what happened. It zoomed up during the lockdown period to a market cap of about $150 billion. And then as the pandemic started to ease and the NASDAQ started to rise with all the money printing, we found that Zoom continued its slide in the last, 5-6 months of the tech sell-off. And this is what's so interesting. It's ended up priced more or less where it was 3 years ago. Now, the 94, I think last time I checked was about 88, 89. So it really hasn't gone anywhere. And in the meantime, Zoom has grown its revenue by about 9 times. It's grown its free cash flow by 50 times. And its earnings per share, it's grown by 150 times. And so this, to me, is just a great lesson of price is what you pay, value is what you get. Now the question, of course, we zoom ahead to where we are today, and you ask, well, what should we do? Zoom is so much of a better company from a fundamentals perspective in terms of its revenue, its profit, its free cash flow. It seems to be relatively fairly priced, PE at 21. It's not too different from the FAANGs. And, is this a good buy? Well, that's a whole different question because it relates to the future, and none of us know what the future brings. But one thing is for sure, it's not priced for perfection in the same way that it was 3 years ago. And I would also point out that Zoom has net cash today, I think of about $5 billion. So here's a company, yes, it's going up against Microsoft with its Teams offering, Google and Hangouts, and there's other teleconferencing products in the market. But Zoom is a company that today is generating over $1.5 billion free cash flow. It has $5 billion of cash in the bank. Its share price being lower might mean that it can offer share options to new employees who might actually get excited by the prospect of Zoom growing in the future from its current 25 billion market cap, which is about 1% of Apple's market cap. So it's just, I just thought I would point this out, not as a buy, not promoting anything here, anything like that. I'm just pointing it out as when we're talking about tech companies that are not established companies like Microsoft, Alphabet, and Apple, then we are taking risk. But the risk we're taking is as much on the price and the timing. Timing's everything, as they say, as it is on the value itself. And Zoom is actually a super interesting company at the moment because over the last 2 or 3 years, while going back to my previous point about the quality of the company and the management, while it's been growing itself in terms of the fundamentals, it's been able to hire more talented team members across the board in every discipline and function, presumably. It's been able to acquire new technology, develop, code new solutions. And that's the essence of a tech company. A tech company is people, right? It's essentially software. It's a platform. In Tesla's case, one can argue, again, whether it's more steel or aluminum than it is software. But tech company generally is software, which is people coding. They're coding the product that they're monetizing every day. And so that's one of the key things that I look at when I look at these companies is the people, not just the people that are leading the company, which is extremely important, of course, but also the people that are being hired. And are they staying? Are they not staying? Are they leaving? What are they saying on Twitter? What are they saying on Glassdoor? Is this a company that is going to do well despite, in Zoom's case, price falling? But is price falling the end of the world? It shouldn't be. If you're Warren Buffett, if you're a value investor and you're looking at like Apple, a value company, which I would argue today Zoom is, that's also growing and it's growing with exponential technology, that becomes a very interesting and relevant question.
There's some great points. I think it's quite hard really to prepare yourself for sort of the one of the sort of idiosyncrasies in technology, which is innovation. You've talked about Zoom. You could equally say, what about Skype a decade ago? To what Meta is today, or Facebook, or Instagram. Those were the Bebos and the MSNs back in the day. So I guess that's one thing. Can you ever really prepare for disruption? Can you ever protect yourself against it, especially if you're betting on particular companies such as Zoom, for instance?
Yeah, the same question goes back on Meta. When for the first time ever, it reported a decline in users, the stock dropped by $250 billion, right, in one day. And that was, again, price versus value. The market just didn't expect that could actually happen with a company like Meta, Facebook, that had grown like it had. And, it's why short products that Will's talking about are extremely interesting but we don't know the future. no matter how much we think we know and how great a company is, or we think it is. Same with Netflix, who expected that decline. I mean, there are many, many cases we can bring up, but that's what personally I love about technology investing, and technology companies, because they deliver so much value to all of us, to the world. I mean, what would our lives be like if we didn't have Apple, or if we didn't have Microsoft, right? We take it for granted. If we didn't have Amazon at a click of a button on our phone, if we didn't have Zoom during the pandemic. I mean, we take often for granted. It reminds me of that book, Robert Pirsig's Zen and the Art of Motorcycle Maintenance, where one of the things he said is, let's not take for granted the basic technology we use every day, like toilet flushing and running water from a faucet. And the same now extends to this amazing technology we use every day. And that really is where the world is going. It's in these moments, it's oil and gas, it's commodities, it's the defense stocks. Sure. That's something that, as you invest or take risk with capital, you've got to bear in mind. But from a long-term perspective, it is technology and technology companies, and investors want to get behind the very best ones with the best management teams, if you're long, to really take maximum advantage of that.
Yeah. Well, we've actually just had a question from the audience I think would be well suited to you. It's asking, in 10 years' time, will all companies effectively be tech companies?
You're asking somebody who's biased. That's part of our particular mission. We believe that. It's inevitable. And it's one of the reasons I wrote the book Go Tech or Go Extinct, because even if you're a tobacco company, if you're certainly an oil and gas company, you've got to techify your entire value chain. You just have to do it because your competitors are doing it. And if you don't do it, somebody else will. And if you're an investor, and it's why we say to our ecosystem, if you're looking at investing in listed companies, take construction, for example, look at a John Deere. It's a traditional company that one could argue might benefit in different cycles, maybe not now, given a recession. But John Deere has done an excellent job of techifying itself with in-house organic innovation, with investing in small tech companies and acquiring. They bought Bear Flag Robotics, I think, a year ago for $250 million. And this is a relatively small company, so very high revenue multiple, much, much higher than the John Deere revenue multiple. But they bought it because this is where everything is going. And John Deere's CEO is a technology guy. He's a former CTO of the company. He gets it. And so if you're an investor, look for CEOs, Ford, by the way, similar case, look for CEOs who have a technology background and who get it, who understand where the puck is going, because things will take 1, 5, 10 years to manifest from strategy to implementation. And if you're a long-term investor, if you're not in tech, then in non-tech, look for the companies that are effectively saying we got to go tech.
Yeah,
I think just also to piggyback on what Paul's saying, the other interesting thing about tech companies, and it's a drum that Microsoft's been banging quite a lot recently, is these are companies that are going to help everybody else do more with less. And as to his point, we can't live without tech at the moment, and especially these big companies that are trying to cut down on their expenses. It's always less expensive if you're doing it through the cloud, or if you're able to do it remotely, or if you can be more efficient through some kind of tech process. So I think that's the other kind of big draw to the sector overall, is you're looking at companies that are helping everyone do more with less.
Yeah, and I think the one thing I was just going to say is that there's been no better example of this to me than the pandemic. In other words, the pandemic was the global seminal event that shut down the legacy physical economy. And the only businesses that were able to survive and or thrive were businesses that were digital. If you didn't have an online presence, if you didn't have a way to sell your product online, you didn't have a business. And so even the most sort of elementary of businesses, such as restaurants, had to, for those that didn't have any online or digital presence, had to pivot immediately. But for those who did, were able to thrive. And I take the example of something like a Domino's Pizza that everybody knows. And Domino's Pizza has gone from being a restaurant serving pizzas to now really a tech company that operates locations that are more like Amazon fulfillment centers than restaurants. And their business is almost entirely online. It's an app-based experience. And they did so well that Domino's Pizza became a member of the S&P 500. And that, to me, is just case in point that you have to be a tech company. It's already here. And there are different ways we can talk about what that means and what that means to different companies. But just to me, there's no better example of what happened in the pandemic. And if you didn't have a digital presence, then you didn't have a business.
Yeah. And in the sort of tech mega cap space, obviously we've had FAANGs, we've then had FATANGs and FAANGs and various other iterations. We shouldn't view any of these sort of acronyms as necessarily a monolith. They're sort of evolving. They will change over time. A question we've had from the audience is actually, how dominant do you think the current FAANG mix-up or iteration will be over the next decade? Do you think that we'll see a complete sort of evolution of the names in that sort of acronym, or do you reckon that some of the current players will sort of remain sort of in place?
I think you're already seeing it a little bit. And again, this is not a future prediction in any ways, but I think you're already seeing it in that, the company that's been arguably worst affected was Netflix. And I think that's a company that, clearly became a leader in streaming. And in my mind, there's no doubt in my mind that streaming is here to stay. That is by far and away the way that people will consume media. But I think what Netflix is finding out is that other people want to stream as well, and there's going to be competition in that market. And whereas maybe a few years ago people thought that in the streaming market Netflix was that monopolistic player, had that position which maybe was difficult for other people to challenge, now with other competitors coming into the market, that's seeming a bit more vulnerable. But if you look at Microsoft, which going back to the sort of the dotcom bubble, obviously, and talking about how, again, we like to look back on that and say, well, every tech company was a complete shell and they all collapsed, etc. Of course, it wasn't true. That Microsoft was a company that was in the S&P 500, was top 10 of the S&P 500 in 2000, and still around today. So clearly still has a very dominant position. Google, again, what's the alternative to Google? I would argue, what's the alternative to Apple? There are these companies in there. Amazon, I think, is just such a dominant position in e-commerce, particularly to the richest, 15% rather of the economy, that it's difficult right now to see who can viably, challenge these companies. But it will happen, like it always happens. That there's a McKinsey study that was put out relatively recently, which I'll just quote from briefly if it's okay. But the average lifespan of a company in the S&P 500 in the 60s was 61 years. Mm-hmm. And then today, that's less than 18 years. And they're forecasting that by 2027, that 75% of the companies in the S&P will have disappeared. So the last statement is pretty shocking, but it doesn't really matter whether you don't have to agree with that or not. It just shows you that one thing we can't dispute is that disruption is at work. And that is the reason why we're seeing the average lifespan for a company in the S&P being significantly shorter today than it was back in the 1950s or 1960s.
And Jamie, I would just add to that, specifically with the larger, mega caps, look for the companies that can reinvent and are looking to reinvent themselves. Apple has done that several times. It has done an amazing job going from Steve Jobs to Tim Cook. I don't think most people expected Tim Cook to not only maintain the legacy and the growth, but actually increase it. With Microsoft, we had the era of Gates, go to Ballmer, go to Nadella. Satya Nadella has done a phenomenal job. That's a true reinvention at Microsoft. Amazon, Jeff Bezos just left. He's a smart guy. He recognizes that it's time to start thinking about how to reinvent Amazon. And AWS and some other innovative things Amazon is doing is showing that. So really important. And one more point on Netflix, it hasn't reinvented himself yet. It did reinvent itself several years ago as a media company. I see Netflix today as more of a media company. But back in the day, when it was competing against Blockbuster, it used technology more than media to completely eliminate Blockbuster from the scene. Technology just did what it does. It kills people off, which is what Peter Thiel talks about a lot in 0 to 1. That's what Netflix did. However, it somehow either lost its way or hasn't yet found the next technology trick, which who knows what that'll be, some form of VR or holograms. We don't know yet. But I think this is the key thing is, what are the companies that are actively looking to reinvent themselves and don't have any fear of reinvention?
Right. I mean, yeah, I think it's, of course, it depends company by company here, but I'm going to block the FAANGs together once again and ask sort of how much innovation potential really is there left in the FAANGs themselves. If I'm being a contrarian here, I look at Facebook. Laura pointed earlier on to the metaverse and the sort of the short video clips. To my mind, I look at the short video clips that they've sort of started doing on Facebook and on Instagram as a bit of almost a copycat of something like TikTok. And metaverse, obviously the idea of the metaverse has been around for quite some time. We've had video messaging and video chats for years. We've had VR in gaming. So I don't know, for me, the innovation there almost seems quite stretched. Is how much innovation potential is there left within FAANGs? And an audience member actually asked, do they need to innovate or can they just acquire disruptors?
Both.
Well, that's it. It's both. As we talked about, it's the innovation of the core business model, can be innovated, but as we've seen time and time again, they have the balance sheet strength and they have the nous to acquire companies that have added, in the cases of Instagram that we're talking about earlier, huge value. And that's the luxury you have when you have a quasi-monopolistic position.
And let's not forget that Android just a quick one. Android was an acquisition by Google many years ago, and I think they only paid $50 million for Android, which today is the predominant mobile platform. I think it sits on 80% of smartphones around the world. So,
yeah, I was just going to say that the same thing. What you're saying about Instagram's videos being a copy of TikTok and all of that. It wasn't so long ago that we were having the same conversation about Snapchat with Facebook and Meta. So, if they've got the money and they've got the people, that's a huge part of the innovation, being able to keep up and stay ahead of the curve. And just to the point of Netflix and sort of what they're going to do next and where they're at, I think it's also really interesting and very important to point out that we've seen more and more often with Netflix management and their earnings, it's coming up that it's not just these other streaming services that are kind of competing with them. We're now looking at sort of attention as a whole. So when they had that WhatsApp outage, suddenly Netflix saw, subscribers start to log in more and watch more. And I think, as we look at sort of who's going to disrupt and what the future of, say, the streaming space is going to be, we have to remember that it might not just be, traditional streaming as we see it today. It could be more of an amalgamation of these short form videos or even metaverse or interactive types of things. So I think there's definitely still a ton of space for someone to kind of step in there and merge those.
Yeah. And look at young people. Young people, are using these devices and content and technology in ways we grown-ups can't really understand. So keep an eye on them too, because they're the future.
And Laura, I'm going to force you to put your equity analyst hat on here. And I've been asked a question by the audience, which is a bit pointed, which is about the S&P and NASDAQ have reversed weeks of losses in the first few days of this week. Does this mean we have found the bottom? Another one asked, is the short trade over? So what's your take on that?
Obviously it's impossible to predict the direction of the market with any kind of certainty. And I think if we're talking about interest rates and how that's going to impact trading behavior going forward, I think we've not seen the end of interest rate hikes. And I think that kind of is going to continue to loom over investor confidence for some time, at least until, I think we're confident that we've hit a peak with inflation.
Yeah, another headwind, of course, and another audience member brings up is to do with potential regulation. Joe Biden, of course, coming into office saying he's going to tackle monopolies, not the first president to say this, maybe not the first not to follow through on it too drastically. Obviously, the EU as well has put Google in some difficult situations. I guess, Paul, how serious a risk do you see regulation being to large cap tech?
It's always been there as a risk. The the big companies, the mega caps, have it more or less under control. I mean, they've invested heavily in protecting against regulatory risk. They have plan A, B, C, D, E, F, and G, and more. And if they are broken up, as opposed, I mean, if you get a slap on a wrist or a tax or a penalty or a fine, it's relatively straightforward for them to deal with. It's almost a one-off, and even if it's a chunk out of their free cash flow or net income for a year, it's not that big of a deal. The thing we read more about is a breakup, and what's the risk of a breakup? Well, I point to previous examples, and the one I like is eBay breaking up or spinning out PayPal. That was not forced by a regulator, but it could have been in theory. But look what happened. I think it spun out at 18, maybe it was 20 billion, something like that. And then PayPal went on to 40, and then it went up, I think to 250, 300 billion market cap, and it's since come back down in the pandemic. But these breakups are not necessarily a bad thing. It's like a spinoff. As long as the shareholder gets to hold shares in each unit, it really isn't that big of a deal. These companies, again, back to Will's point, are so strong across the board. They have to be, because if you're part of that company in a small division or a unit, a SWAT team, even an employee, if you're not strong enough, you're out. So they're strong across the board. If they get broken up, then they'll swim fine on their own. So I don't really see regulatory risk as a factor at all. Not that it isn't. It's just my view. I wouldn't be that worried about it.
And as we're sort of closing towards the end here, I want to sort of put a bit more of an interesting question. You obviously, so regulatory risk is on the one hand. What about personnel risk? Obviously, we've got some of the biggest personalities in the world in the tech space and some of the most well-known faces. Obviously, you mentioned Tim Cook. We've got Bill Gates and, of course, Elon Musk. How much of a risk, this is pointed to all of you, whoever wants to take this, how much of a risk are these sort of personalities to the underlying companies themselves?
I think, obviously whoever's at the helm of a company is going to be important from an investor standpoint. And a lot of that's going to depend, on your own personal viewpoint. But I think it is important to consider that, nowadays ESG concerns are much more at the forefront of investors' minds. And along with that comes, some attention being paid to what these guys are saying and doing. And I think it's definitely something investors have to think about. But, that being said, I think that, the tech industry is full of big personalities, and you wouldn't have that kind of innovation without them. So there's give and take.
Yeah, I think that you again, as Laura said, it's about the leader, and all leaders are important. But I think that maybe to kind of riff off of Paul's point about evolution, is that if you take the FAANG in a sort of broader construct and include Tesla, then the original founder CEOs, for the most part, have gone. With Jeff Bezos just recently leaving Amazon, so you have Mark Zuckerberg still at Meta, and you have Elon Musk at Tesla. Although arguably we could technically say he's not the founder, but that's another story. So I think that you have two founder-led companies. The rest obviously have transitioned into professional management, professional CEOs, etc. And I don't think you can necessarily say at this stage that one is better than the other. I think they all have their pros and cons. It's ultimately about the strength of the leader and the leadership team that will make the difference in that company. I think sort of a final point about what the rest of the year holds. To me, this is going to be much more now about fundamentals. In other words, in this market, I think we largely know what is going to happen with interest rates. The market's already pricing in the interest rate expectations. So I think it's going to be more about earnings. And we've had really good earnings across the board so far this year, generally speaking. But I think if those earnings start to deteriorate towards the end of the year, then we're not, that's where we're closer probably to a bottom, if we could say that. But I think it's going to be much more about earnings for the rest of the year.
Mm-hmm. Great. And for Paul and Laura, just as we are about to close up here, could you just give me a sort of 30-second summary on where you think FAANGs will be going over the next decade or so, and which areas are ripe for disruption?
Yeah, so I mean, I think the FAANGs are in a great position to continue thriving for the most part. to Will's point, I think fundamentals are going to be hugely important going forward. And in a couple of cases, like for example, Netflix, we have to see them prove their worth before we can kind of say, yes, they belong in this sort of bucket of mega cap disruptor tech stocks.
And you, Paul?
I think we'll see a few new FAANGs. We might see one or two fall out because that's the nature of things, disruption. I think we'll see some new FAANGs, and that may be based on new technology that is being introduced to the industrial world, things like robotics, machine learning, AI, all the things Kathy Wood will talk about, automated vehicles, drones. There is so much happening. If we go 10 years out, it's a long, long time. It's much longer than 10 years was 10 years ago. So expect new players and expect a few to fall out. The strongest ones, it's all probabilities in my mind. So the most likely ones are the ones that are very well managed from top to bottom, including the board and corporate governance. Very important.
Yeah, great stuff. So just as we close out, I just want to point towards, sorry, I should load there. I just want to point towards our next webinar, which will be on Russia and weighing risks and opportunities in emerging markets. Also towards our largest event of the year, which will be next week from the 24th to the 26th of May. That's our ETF Ecosystem Unwrapped event. Also a reminder, please, to download the latest edition of our ETF Insider magazine and to take a look at the attachment section below. I'd like to say a massive thank you to all of our speakers for joining us today and for all of our audience members for listening in. We hope to see you again soon. And until then, take care. Thank you very much.